What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is May 21st of 2022. Well, folks, I hope you're having a fantastic weekend wherever you are, and in today's video, we're going to be talking about two key topics. We're not only going to be diving into Bitcoin's price, taking a look at the chop that we've been calling for the past few days since the capitulation candle, but on top of that as well, talking about the macro perspective, diving into equity markets, and trying to answer a big question. Are we just at the beginning of this bear market in equities, or are we at the tail end of it? Are we going to start seeing some green price action? And we're going to turn to history in order to analyze this, in order to see whether or not we might see some leg up room for crypto here in the coming days. Now, outside of that as well, we've got a sponsored review of the Energy blockchain, a long-term partner of ours here on the channel, with a lot of exciting updates that you guys won't want to miss, so stay tuned for it. Now, if you guys enjoyed the video, consider dropping a like. Let's go ahead and dive into the conversation. Now, as you all have probably recalled, and again, one thing I want to emphasize is you guys might see some of my titles sometimes, but I always recommend you guys watch the entire videos if you have the time for it, if you can tolerate my rambling. Because in the previous few videos, we talked about this concept of chop. We talked about after capitulation candles in crypto. All the while, we did see a pretty hefty rebound, reversing a lot of the losses on May 12th. From there on out, we've been seeing this chop and price action, this kind of consolidation between a given price range, where again, there's no clear trend after the shakeout in the market, after all those liquidations. And this is very, very common in most of the liquidation events, not only in crypto markets, but in a whole range of other asset classes. It's just the general psychology of the market. We're waiting to see if the bulls and the bears will take control and continue the trend in either direction. It's a no trade zone. It's in this zone that we basically want to just sit on standby, see what happens, and wait for a clear confirmation. Now, considering this here, all the while we've been in this chop range, we've continued to see some scare in the global equity markets. For example, with the NASDAQ here, we've come down to a total of 31.6%, rolling down yesterday on Friday, the last trading day of the week, down towards new relative lows here that we haven't seen since as far back here on the chart as October of 2020, closing down a lot of these March 2020 gains and stuff since we really kicked off the cycle after the Fed started injecting quantitative easing into the market. Now, all the while, this correction has been a hefty one, and it technically will meet the definition of a bear market in equities. I want to make that very clear. There's a big distinction between a bear market in crypto and equities. But in equities, all the while people sometimes debate about it, the general industry standard, especially from analyzing history, is that a correction of over 20% or more is deemed a bear market. Okay, we are clearly in a bear market for equities right now. Hands down, we're down 31.6% for the NASDAQ, and the S&P 500 and the Dow Jones have entered into similar correction territory. That all being realized, one important nuance that a lot of people don't understand when it comes to the terminology of calling something a bear market is that when it reaches these exacerbated levels that we define as bear markets, it's usually not the time to panic. It's not the time to sell into absolute fear. And all the while, I'm not telling you guys right now to go rush into buying equities, buying up Apple stock, or for that matter, going out and buying cryptocurrencies. I do want to emphasize that we need to focus on this question. Are we just at the beginning of a bear market? Because sometimes they can drag on much longer. They can go down to 40, 50%. And in worst enough cases for certain indices that are overblown, like the NASDAQ was back in the dot-com bubble in the late 90s, we saw, in this case, what many people would argue was an overall like 65, 70% correction, if not worse. So we need to keep open to this here. Now, I want to first go ahead and as we're diving through the charts here, just take a look here at the previous few years. Really take a look over the last decade here. We've had some corrections along the way here, but really the last three here have generally been within this ballpark of that typical 20 to 30% correction range. Very similar to the one we have right now. Now, there have been some harsher ones in the past as well. We've had the 2008 recession, the housing bubble, collapsing not only the housing market, but also other financial assets. And we saw that, where we saw basically the NASDAQ go from 2250 down here towards 1,000 points on the index, 54.5% correction. And then you had the worst case scenario here, This was really the bubble, in this case, the exacerbated retail-driven dot-com bubble back in the 1990s, where we saw the collapse from 4,800, down to 800 points on the index. Now, I want to make it very clear here, while we are certainly not in this situation where we're going to be seeing probably an 80% correction in equities, there is not that type of PE multiple or crazy out the wazoo stock IPOs going on here today than there were back in 2000. Trust me, it was a different degree of crazy. All the while, it is important to understand that we don't have to stop at 20 or 30%. It could go on further than that. I think it's important to keep open to that overall in the market, to understand that we need to dig a bit deeper before we can feel confident that we aren't going beyond that, okay? So let's go ahead and take a look here at some key metrics. First off, one thing that I think is really important to watch, and there are a few technical indicators that I like to use. You guys know I'm a naked trader. I, in this case, like to focus on support and resistance. I like to focus on what price is telling us. But sometimes, especially on prolonged time frames, I'm talking at a minimum the daily, but more likely the weekly and the monthly chart. What I like to do is sometimes dive into some of the long-term favorites, like the Relative Strength Index, the RSI. And the RSI is going to give you a great gauge here. Again, it's not picking it on the absolute day, but it is going to give you a good idea here as to when markets are oversold, when strength has gotten too low here, where we can expect that buyers will come into the market in some capacity. Now, if we go throughout history here, I could draw a lot of these similar corrections here because we've had some back here in the NASDAQ, back here in the 80s and the early 90s, at very similar kind of range here, somewhere between that 20-40% range, more likely 20 to 30%. But what we find each and every time here is that when we get below the 30-point range on the RSI, you are a few weeks away here at a minimum, or excuse me, at a maximum, sorry. So more likely short in this case rather than just a few weeks from the bottom here, and or at least a period of relief or a dead cat bounce, as it's commonly referred to as. You can see that here even during the worst correction here for the NASDAQ, whether it be the absolute bottom here of the dot-com bubble or these kind of midterm periods of time during the cycle here, where as we dipped below here, we got a relief rally of the overall indice. And this is an important thing to bear in mind here again, whether we are going to have one of those shorter 20-30% bear markets, and that's the end of the story, we don't know yet. But at the same time, even if we're having these drawn out corrections, historically speaking, when we come down to this range, like we did in March of 2020, like we did here in December 2018, just like we did in November and December 2015. I remember I've traded a lot of these cycles back in the day before I started my channel. I remember living through these. Again, it is the worst thing to do to absolutely panic sell into fear. If anything, even if you believe it's a bear market or there's going to be some continuation, you wait for a relief rally. You wait for optimism to churn back into the market, because more likely than not, it is going to rebound back up to some degree, and you'd be better off waiting for that return back to some normalcy or optimism in the market before taking profits off the shelf. And that's, again, exactly why dead cat bounces are so important, because while you've got this period of fear in the market, people buy into that fear. They, again, are buying with the idea that this is the absolute bottom. They drive up and there's a lower high. This is, again, a big reason why we focus on that naked trading principle of higher lows and higher highs, lower lows being a sign of a downtrend, right? So there's lots of things you can turn towards. And I think, again, if you're going to use indicators on these charts, I recommend using it on the weekly. You can get tons of insights here going on the long-term viewpoint, and you'll see where we are right now is very similar to the range that we've been in previous bear markets and equities. And it's important to note that it doesn't last very long. We do not sit in this range very long without getting some kind of relief in price. And when I talk about relief, I'm talking about a serious, double-digit move up in price, recouping weeks, if not months, of losses in some of these bear markets, and sometimes even formulating the bottom. So that's the important thing to bear in mind here. Again, as we're, a lot of people have been emphasizing, but Nick, focus on the equity markets. Trust me, guys, I love keeping track of the equity markets. It's where I got my kind of experience in equities trading. And the worst mistakes I made, I can give a great example. on that correction I talked about in 2015. All right, a little bit of a self-taught lesson, and this was again back at a time where I was messing around, making all the mistakes of an equity trader. I was trading on a leveraged ETF for the NASDAQ at the time. I was doing really good, day trading until it stopped working, until the market took a hefty correction. People were fearful at the time as the Chinese stock exchange, and I think it was the Shanghai Composite, had really popped as the retail-driven bubble in China had popped and dragged down the rest of global equities with it. And that fear and concern led me towards buying in this range and selling into fear here, right? Now again, it's important to understand to not sell into fear, to wait for some kind of relief rally in the market, because just a couple weeks later, I would have been able in this case to sell it right back where I did, if not at a profit from where I bought it. So again, I understand guys, things are scary right now, things are worrisome, but again, you sometimes just got to stomach it. You got to just hold out on the volatility and wait for buyers to come in who see value. Rarely ever throughout history do we just see an absolutely vertical decline. And usually, as we saw in March of 2020, when we do get these types of corrections, and bear in mind, one that's very similar in percentage decline to where we are now, you'll very likely get the Fed or someone coming in. The markets cry uncle to Jay Powell, and they come into the rescue. It's played out too many times to count history. And all the while, the Fed is talking the talk. And they have raised up a couple basis points now. The Fed can always change its tune. And it has done so more times than not. The vast majority of the times, it always goes back and reverts course. It has to play this tightrope of balancing pressures of inflation, stimulating economic growth, and at the same time, supplementing asset markets that have really been the backbone overall in this case of the financial system for the last few years and people's wealth, right? The economy has become so financialized. Anyways, I'm rambling on here. Now, the major thing I wanted to show you guys, again, maybe to just kind of visualize this here, this is a really interesting measurement of the S&P 500. Now, again, one thing here that I think they don't do justice on, and I'm just going to go ahead and say it like it is, even though it doesn't fit per se to what I want to share here today, is that they really don't. I don't think they honestly cover the bear market of the dot-com bubble accurately, even though it wasn't as harsh as the NASDAQ, as technology stocks really make up the NASDAQ, not the S&P 500. Still, this is not two separate corrections, right? You could still see it in this case for the sake of our argument here that overall after a 31% correction, we did get a relief rally here. So this is like a good example here. After the 36% pullback here, in the market, very similar correction range where we are now, we got a 21.4% bump up here. Really solid move in a very short period of time as well. And that's, again, one of those relief rallies you can sell into. So maybe it's good for that kind of context. Same here with the bear market here back in 2008, right? We got the correction of 52%, bounce up 24%, right? Covering up a couple weeks of gains, weeks of losses, right? Now, we can see here again, going over the past though, most of these bear markets, 27.9%, 22%, 36%, 48%, 27%. Most of these are coming in at an average, even the newer ones here in this case, around 30%. And we really only get the kind of exacerbated 50% corrections, 70% corrections when there is systematic, parts of the economy that are either way overexposed, way overbloated, like the dot-com bubble when technology stocks were just valued at ridiculous valuations, or when we have systematic issues, for example, like in 08 or 2006 to 08, when the housing market collapsed. And that's really what can drag people into a prolonged bear market. Again, even considering that though, we still had midway rebounds or relief rallies where things got better. All right. So again, this is really going back throughout history here. We're not looking at the 5-minute chart. We're not looking at the hourly where things look absolutely doom and gloom and it's very easy to get caught up in the market. Instead, we're focusing here on what history tells us. Are we at a range here where we could be at least experiencing some positive price action here in the near term? And I think we're very much getting towards that. I think you're going to see the Fed walking the tightrope, saying, we're going to slow down our move towards quantitative tightening and maybe raise at 25 basis points. And inflation is not that bad, right? No matter if it's true or not, no matter if it's the best decision either or, we need to understand that the Fed is probably not going to stick to its guns on everything it's saying. We'll have to see. If it's really pulling a Paul Volcker, then that might change the game and really give us the full 40-50% pullback. But I just don't know if I can trust the Fed yet with what they've said. And either way, we should expect, according to history here, that equities will see some kind of relief. So again, I don't want to be absolutely too bullish, guys, but at the same time, all the while I can admit here that in equities, in traditional stocks, we are in a bear market, and crypto is definitely in a period of negative sentiment or could very well be labeled a bear market. Again, crypto bear markets kind of meet towards the overall 80% correction. Of course, I don't want to wait until 80% to call it a bear market, but you get my drift. I don't care about the labels here that we're calling it. What I care more about here is whether or not it's a time to sell or it's a time to buy or hold and wait out for greener pastures. It's the key goal in markets, is to not get caught 2 steps behind. So anyways, guys, that's it for the market analysis here, but let's go ahead and dive into today's sponsored review with a lot of exciting updates for the energy blockchain. Alrighty, everyone. So in today's sponsored review, we're going to be diving into a blockchain partner of ours on the DataDash channel that we've covered for a long time here, as far back as 2018, and that is no other than the energy blockchain. A layer 1 blockchain focused on building not only a highly scalable experience to interact with DeFi and NFTs, but on top of that, to build a secure, community-focused experience for users to make it easy to get into the crypto space. And Tommy and the team have been working hard behind the scenes and have some really exciting announcements to share here today since we last covered the project. The first thing I just want to mention here is, for those of you who may not know, Energy has been focusing heavily on DeFi for the past year. And since the launch last year of Energy Swap, it's been seeing high numbers of growth week over week during the upswings and downswings in the market, doing millions of dollars of volume every week. And for an emerging layer 1, this is really exciting to see. But Energy is not stopping here at just servicing the DeFi market. And they made a lot of interesting strides that we're going to be covering here today around the NFT market. Again, something that I'll be candid with you guys, I'm a little bit new to. It's a little bit out of my comfort zone, but I have to say some of the changes they're making and some of the ways they're moving in the market are really exciting, from some of the projects they have coming up, as well as launching their own NFT marketplace. So we'll get into more of that as we go throughout the video. But the first important thing to talk about here is the recent investment from Gem Digital Limited. They've raised a commitment of over $50 million to continue expanding out the energy ecosystem. Now, this is pretty exciting news because all the while here, and I gotta say it's quite impressive as well, it's not usually seen in crypto, is that Energy, for the longest period, for the last more than 4 years here, has been able to operate in a self-funded manner. Energy never did an ICO and never did any pre-mine. Instead, it opted in to self-fund and build on its own through people like Tommy Power has been leading up the project since its inception. And on top of that as well, to go even further, rather than kind of keeping all the tokens for the team, they actually did an earn drop campaign where thousands upon thousands of users across the world were able to get a stake in Energy in the early days in order to have an incentive to build value in the ecosystem. Now, you put that on top of having a treasury and a variety of applications that are now starting to take off on Energy, I think you've got a recipe for success in the long term. Now, all the while here, again, Energy is still kind of smaller in the grand scheme of things. This investment here from Gem Digital Limited will be able to give Energy the resources to be able to scale it and build a whole new range of applications, hire more, build more value, and capture more of the DeFi and NFT markets in the crypto space. And that's going to help hedge it very well here, especially during these turbulent times in the crypto space. So let's go ahead and talk a little bit about some of those interesting applications. The biggest one being its new pivot and focus on NFTs and its new platform, Gonna Make It, or GMI. Now, this is obviously around the overall crypto expression that's used a lot on Twitter and in the crypto ecosystem as a whole. And the general premise of GMI in this case is to build a competing marketplace for NFTs. And the biggest thing that I think is really important to understand here is a little bit of the nuance here about where GMI kind of plays as a project and what chains it's going to be on. Now, it will be on the Energy blockchain as well, but the main home here is going to be on the Ethereum ecosystem to really capture a lot of the major market traction. That's where most of the NFT volume and NFT transactions are generally happening. So within the Ethereum ecosystem. So This is really exciting, not only again for the overall ecosystem to bring more users in to the overall umbrella under Energy's product line, but outside of that as well, there will be the same service offered on the Energy blockchain. And it will allow you to interact and trade with a whole range of different NFTs. But unlike platforms like OpenSea that charge pretty high fees, haven't innovated too much over the last year or so, and have just really kind of taken advantage of their position, Energy is focusing on taking a similar model from a project known as LooksRare. It's a very similar concept in this case, where you'll be able to take in fees from these transactions, these trades on NFTs, and give them back in a sense of yield back to the stakeholders. Now, the important thing here to understand is that there's going to be a new token here that's launched called GMI. It's the native platform token here for the GMI marketplace. And there's going to be an ability here to lock in liquidity here between the GMI token and Ethereum to add deep liquidity for this token pair here and earn APY on top of it. Now, the yield range can be quite high here. It's pretty typical here when you're going to be putting up two tokens, in this case, whether it be Ethereum and some kind of altcoin like GMI. You're going to be able to earn some kind of yield in this case. So it's a form of yield farming. Again, I always emphasize and want to stress here that all the while you guys can get some great yields. Make sure you understand that this capital here is not long-term capital that you need and stuff. It's always important to understand that around yield farming. I think it's just a fair disclosure. Yield farming all the while, it can be very lucrative. It's important to understand here the ramifications of it, to understand the project long-term, to understand the fee generation here. It's overall been seen as a pretty successful model so far in the crypto space, and probably one of the best contender models to OpenSea and some of these larger players. So I think it's definitely something to keep an eye on here, to learn a little bit more about and see whether or not it's something that clicks with you. But it's interesting to note here in this case that there will be the native token here on the platform, and the overall user experience for me personally looks really clean here. Again, NFTs, a bit new to me here overall, but again, being able to trade a whole range of different NFTs here and stuff within a new interface that's putting up a little bit of a competition against OpenSea is really exciting to me. Now, it's one thing that NFTs in this case are a focus of Energy and that they're building their own marketplace. It's another in this case that they're going out through Energy Studios and really developing some of their own NFT creations. And I gotta say, some of these are some of the best I've seen in the 3D art space for NFTs. There's haven't really been many great NFT projects that I think have really gotten down the 3D art style. And Energy Studios is focusing on two major ones right now. They've seen, as you guys have probably heard here on the channel, or at least I've covered it before, the Royal Dragons here. So they've started to get a much wider range here of designs here for the Royal Dragons and different uniforms and attributes. And then outside of that as well, they've also got the Immortal Samurai. So this is honestly one of my favorites here that we haven't talked about yet much on the channel. But the Immortal Samurai I think looks really interesting. Some of the designs are really creative. And what's really nice about it is that this is coming straight out of the Energy ecosystem here. So we're starting to get a lot more kind of the initial creativity that will spark a lot of community content creators to come out into the Energy ecosystem and start crafting ideas themselves. So it's really exciting to see here this kind of base foundation getting set up here. And they're going to have NFT minting. They're going to have a whitelist contest. So definitely, if you guys are interested, check out that. And you can earn a whitelist spot here for the Energy Studios whitelist contest for minting. Now, the last big thing that I want to talk to you guys about here that I think really builds into this commitment from Energy to really start making some major strides here in the coming months is that they've committed over the next 6 months to doing a $1 million Energy buyback program. Now, a lot of protocols will kind of do this to showcase here overall growth in the protocol, but outside of this as well, an emphasis on being bullish on the platform long term, right? They're making a commitment here in this case, taking capital that they have in reserves and committing to buying back Energy as they believe that Energy overall will likely appreciate over time, similar to like a stock buyback. So the important thing about this is that it is going to generally add buy-side pressure to the Energy token, and it shows a commitment from the team to really provide value and take Energy to the next level. Again, we'll have to see here how the NFT platform launches, how GMI, both in the Energy ecosystem and on Ethereum, can really play in to benefiting the Energy token. And outside of this, well, some of these new collections like the Samurai or Dragon collection from Energy Studios, how that's going to help Energy in this case overall. There's a lot of exciting developments going on here. I like that all this has come out kind of at once. There's been a lot of things happening and brewing behind the scenes here for Energy. And it's just interesting to see, especially not only how some of the applications like Energy Swap have really gained solid recurring traction, but on top of that as well, that Energy is now branching out into a whole range of ecosystems. And it's really doing it one step at a time in a really quality fashion and trying to think about creative ways to kind of break into offering these services. And I think a great way of kind of showing this again was with the affiliate analytics here that Energy Swap offered, the ability to actually have referral fees or referral links that you're able to generate revenue from when you bring new users into the protocol, swapping between various tokens, all while doing it in a secure and scalable way, with a big emphasis on security and fighting fraud in the crypto space. Gotta say, that's one of my favorite opinions that Tommy has that unfortunately isn't taken serious enough in the crypto space. And it's important, especially when it comes to NFTs and swaps. With all the fraud, all the problems that can happen in the NFT space, with the Energy Defense Force in this case focusing on getting a lot of people to have that kind of protection, being able to come to report about issues. This is a huge safe haven here for a lot of people participating in the NFT space. Doesn't say there's no risk whatsoever, but a much, much lower degree comparative to that on, alternative layer ones like Solana or even within the Ethereum ecosystem. So there's a lot of things you guys can dive into with the Energy ecosystem. I'll leave some links down below in the description so you guys can read into it for yourself, make your own decisions. Again, all we're doing here is just talking about some of the really interesting updates, but I recommend you guys do your own due diligence, look into it. And if you guys enjoyed this review or the core content where we're going over the equity markets, please consider dropping a like. If you made it this far, I appreciate you listening to me ramble. And until the next video, thank you all so much for watching, and I'll see you all in the next one. Take care, everyone.